Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman & Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, Kilroy Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, First Service Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Massey Knakal Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal & Rosenthal, Signature Bank, Sterling & Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Group.
Hello, my name is Michael Stoller. You know, each year I make sure that I try to bring a group of young, dynamic real estate leaders together. So today on this show, this second to last show of the 8th season, I brought together certain people, one in particular who's been here a couple of times, and 3 others who haven't. And some of them, you know, they've only seen the good times in real estate. And we are in the difficult times in real estate. So my guests today are Will Silverman, Corporate Managing Director of Studley, Brian Ray, Managing Partner of ABR Partners, Kevin Chisholm, Principal at Savannah Real Estate Fund, and last but not least, the youngest guy in the group, Jeffrey Rosenblum, Vice President at First Metropolitan Properties. So the kid from Murray Hill, 27 years of age, came out of Lehman Brothers, then worked for Newmark. Now you're in the real estate business, the family business, and other things. When did you graduate college?
2004.
2004. The streets were lined with gold. He's 30 years of age, so he saw it also. I mean, it was a great time. You went to Lehman. You went to this big, huge company. What do we see happening today? How do you reflect the 5 years since you graduated?
We're going back to fundamentals. People were buying things based on future growth, and they really didn't even know how to run the properties. They didn't even know what they were buying many times. They were buying based on the fact that someone else is going to come along a year later, maybe 6 months later, and buy it for more than they bought it for. So the NOI was going to stay the same, and they were going to sell for more.
That's a perfect lead-in to the man who sold them. Mr. Silverman, you've been in this business, what, 6 years, 7 years now?
7 years.
7 years. And you've seen only up over the 7 years. I know we've spent time together, we've done things. So, and you sold properties to these people. What's happening today?
What's happening today is the absolute diminution of transactions in the marketplace. There are very few things trading. There is I would say that no one who doesn't have to sell is a seller right now, and people are recalibrating their definition of what it means to have to sell. And by that I'm referring to the fact that many banks that people thought would have been sellers of loans as deals went underwater have not been as of yet, and may not be going forward.
Now, are there buyers?
I think there are. I think that, you know, there's a lot of talk about the money on the sidelines. I'm not sure that as much money was raised as people had intended to, but a substantial amount was, And we're still getting calls. Yesterday we sat with Israeli investors who'd never been in the market before. Last week we went around town with a French investor who'd never been in the Manhattan market before. And 2 days ago we had lunch with people who've only owned multifamily in the boroughs who think that this is their moment to get into Class A Manhattan property. So we are starting to feel the sense that there is money there waiting for the opportunities.
So my question is, here we have Mr. Ray, who says he has friends and investors who want to invest. When is the time to invest?
I think it's upon us. I think it's back to looking at fundamentals and seeing at deals that make sense. And if you can underwrite a project that you think you can survive in the near term, why not go after a good opportunity?
How do you look at a deal? I'll ask you, I'll ask all of you, how do you underwrite? Because as we were saying prior to the show, Mr. Chisholm has a property, his fund has a property in Edgewater, New Jersey. You own buildings in Manhattan and in New Jersey where residential rents are dropping, where you may be giving, how many, two months free rent maybe?
Some concessions.
You maybe have to give concessions also. How do you, I mean, you're a fund. You're the guy who has money. But you also have a fiduciary responsibility to make the right decision. So how do you look at it this way? How do you and your other principals look at what they should do with the money that you're holding? Because you haven't used all of your money, right?
Our fund's about 75% invested, which means we have about $80 million left to spend.
So you have $80 million left to spend. What are you going to do with that $80 million? Are you going to take the money today and use it? Or are you going to be like, I don't know, you were at my symposium where I had all these funds over there saying that they represented maybe $15 to $16 billion of money available, and they weren't spending it. They're waiting. Or they're waiting to buy debt, and they want a 25, 30% return. What are you looking to do?
We're out there trying to buy deals every day. And I would say, just to begin with, we don't anticipate spending all of the $80 million. When we look at some of our, some of the other funds who are out there, one of the issues we see people struggling with is that, they had $80 million to spend and they spent all 80 of it and didn't hold any in reserve. So we would anticipate, putting out some, but not all of it. And in terms of, looking for deals, we spend most of our time trying to build relationships with banks. We really are not trying to buy the equity in a deal these days, and we are being very conservative in our underwriting. And if we can get our price, we certainly would buy a deal.
But prior to the show, you were talking about readapting space. You made an investment a couple years ago, great location, right near Madison Square Garden. And what did you do with that?
We bought about 100,000 square foot development site. We fully designed a retail and rental apartment building. The financing market changed between the time we sort of bought the deal and went to market for the debt. We thought we were going to get 75% financing on a non-recourse basis, and when we finally got our quotes in sort of the fall of '07, turned out it was 50% financing on a full recourse basis, and we decided that rather than build a purely speculative rental project with full recourse debt, we just put the project on hold, and we are renting out the development site. We've signed a lease with a parking garage operator, and we're going to sort of reevaluate our option, periodically.
Now, it's interesting, Will, you represented them in the sale of a property in 2007.
Correct.
At probably one of the height of the market for a building which you only owned for a couple of months. It was a great investment for you guys. So let's talk a little bit about what values have dropped recently. That building, which was on 33rd Street between 6th and 7th Avenue, sold for about $400 a foot. What do you think in today's market, that building, which is a Class B office building, nothing negative, it was it served the purpose. How much do you think that would sell if it could sell today, if it could fetch that amount of money?
Almost certainly nothing can fetch the amount that it fetched in 2007.
Okay, don't be evasive. How much has it dropped?
A fair proxy for most income-producing real estate in New York is a third to half. I don't know enough about the leasing situation since we sold the building
so I'm
to say whether it's the third or the half.
It's a third to half.
From a third to half.
But now let's look at it this way. It has no rental income because they vacated every tenant in the building. under the plan of making it an office condominium. So how much do you think it could sell for, since it has no cash flow, except for the rental income from the 2 bars?
I think that if you're selling a vacant building, and I'm not positive that it is a vacant building, at that location, you're probably looking in the low 200s a foot. And I think that, and that's not, I don't think that would be a terrible deal, because you're still 1 block from Penn Station, and you're at one of the major transportation
So
hubs.
you know, everybody talks about, and I'll ask any one of you to answer the question, everybody's talking about the sale of the 2 AIG properties downtown on Pine Street and Wall Street. The building sold for about $85 a foot, if we can believe the numbers, but it probably, because many people who are on my show discussed the show, the property. This property would have sold 2 years ago in 2006, probably at $400 a foot, the same price like our friends at 14 Wall Street paid at that situation. Why did it sell at such a low price, Mr. Rosenblum, Mr. Chisholm, Mr. Ray? Who wants
It's an empty building. It's a million+ square feet of office in an environment where it's extremely difficult to grab a new tenant. So I think that they have some time on their hands, and It's going to be difficult to navigate.
I think it's pretty simple to understand why values have dropped so much. Rents have come down. Rents are off substantially, and at the same time that income is down, operating expenses are going up. Real estate taxes are certainly going up. So just on a fundamental level, you're getting less income out of the property. And then the other side of the equation are the valuation metrics. At the same time, the fundamentals are deteriorating. Your valuation metrics are deteriorating as well. I don't think anyone would argue that
yes,
cap
Brian.
rates
I
have
think the
gapped out.
biggest difference now is the capital markets paradigm has shifted. And I don't think anybody knows where it's going. Are the banks getting healthier, or are they not getting healthier? If you look at New York over the last few hundred years, property values will always go up. So if you can buy a building on Wall Street in that area today at a very reduced level, and you can survive the next couple of years, there's going to be a tremendous opportunity.
Now, the interesting thing is, Will discussed prior to the show that his colleague in crime, his partner, Woody Heller, sold a building in Wall Street in the mid-'90s for $14 a foot?
No, it was in the early 90s for $7 a foot.
$7 a foot. Now, this isn't at the same price. Now, that building that he sold at $7 a foot would have fetched $400 a foot last year. Today, it might fetch $200 a foot. But there is a value for the land. I mean, you built a piece of property right now. You have a beautiful professional office condominium on the Upper East Side, as we would say, in Doctor's Lane, near all the hospitals. How much did the land cost you?
Let's just say that we saw an opportunity to buy a parking garage.
The land price, if you had to say.
We didn't pay for it as land. We paid for it as a development opportunity.
As a development opportunity, it still cost you perhaps $300 a square foot?
Not even.
So fine, $300 a square foot is what I'm saying. So a piece of property in Lower Manhattan, which is this is an iconic. It's the 5th largest, tallest building in New York City. At 972 feet. So this building, isn't the land worth more than $80 a foot?
It's a liability, though. You have
Exactly.
you have substantial. You're going to have an empty building in a year when AIG leaves, and you're going to have a huge operating shortfall. And who knows when that when you're going to have to stop feeding the property.
Not to mention there's costs ahead of you. So you're going to have to re-tenant the building. There's going to be TI, LC, leasing commissions.
But
you're
if
going to
they
have to pay.
underwrote that risk into the project, let's see how it unfolds.
Now,
Who are we to judge?
No, that's exactly right. Now, what hasn't come out is the story with regard to the other AIG property, which sold in New Jersey. Now, everybody said it sold in New Jersey, and nobody really knew the price. The price wasn't identified, but the price came out if you read through the articles. This was a 235,000 square foot building in Ridgefield Park, right off Route 46 and New Jersey Turnpike, and the investment sales broker stated that he got 17 bids on the building. And the price bid was between $25 and $50 a foot for the whole building, for more of a B+ or A- building. Look at the difference in values over there. This is an interesting market.
Well, Michael, one of the things you're identifying, particularly on these AIG buildings that are more or less being sold vacant or subject to very short-term subleases, is the difference between economic value and speculation value. You can't make a model in Excel that would say that any of these buildings are worth anything today based on where we are today. So then it's simply a matter of someone saying, well, they don't have an economic value, but simply as a speculator, and it sounds like Brian believes in this argument, as a speculator, there's a certain price at which I'm simply comfortable owning an office building in New York, and that is the price at which I will bid. So it's become, I would say that underwriting, to the point of your earlier question, has become a much less quantitative exercise and a much more qualitative exercise.
So yes.
Also, 70 Pine is it's in Manhattan. You're not comparing apples to apples. So Manhattan is a high barrier to entry market. There's a finite amount of land. So you're comparing that to New Jersey, where there's low barriers to entry.
New Jersey is a nightmare. I mean, the office market in New Jersey is a nightmare. I was just trying to talk about low values.
I think there's another sort of phenomenon or concept to keep in mind when thinking about the value of 70 Pine and why it's low on a sort of price per pound basis, and that's the fact that it's a big deal. There's a premium on liquidity right now, and this is a reportedly $140 million deal, which presumably would be very difficult to finance if there's any financing at all. And in this environment, if someone's going to be able to write a $140 million equity check, I think they're going to look for a steep discount because there's just not a lot of competition.
So here's my question. I mean, there's not much selling, but how are the banks reacting today? How you're out there. You said before, your office condos, you've heard that these banks want to finance these wonderful doctors. I mean,
I think that it's definitely challenging, but I think it comes back to the property level fundamentals. If it's a good asset, it's a good asset class, it's a good user, it's a good sponsor, good developer. I think if you have good projects over the next couple of years, you'll get financing, you'll get equity.
Let's look at, there was an entity called Circuit City, good operation, and if you look at it, there was really not that much competition. You had Circuit City and you had Best Buy, plus you had Walmart and some other places. Circuit City went bankrupt. Now you got a nice hole in the ground on 43rd Street and 5th Avenue. That's vacant. Great location, right?
Great location.
Great location. Go a block away, you have a bank location on the other side of 5th Avenue. That's vacant. Go up 2 blocks more, you have a former Garrison popcorn place that's that's vacant.
But as you like to say, all these bodies in the street, all of a sudden, this is where the opportunities are for guys like us, is to find the right assets, capitalize them properly, have a vision of the next 3 to 5 years, and that's the best way to look at it. The last couple of years, 06, 07, you bought a building at a 4 cap. What kind of opportunity was that for guys like us?
But people bought. I mean, Will and Woody sold a lot of property. I mean, let's understand. You sold the property to former colleagues of mine, an apartment house that was built, and they bought the property without any cash flow. I mean, it had no benefit, and they thought it was going to be converted to cooperative or condominium. I don't know what's going to happen, because the problem is I don't think those people can get mortgages today.
Well, I think in that particular example, that was a property that was a 1 million square foot property in lower Manhattan that was subject to an obscure form of rent regulation, and they had 2 avenues they could pursue. One avenue was a court battle to put it into a more traditional form of rent regulation that would have allowed them to increase the rents. The other avenue was the negotiation of a co-op agreement with the tenants. I actually still think that they're attempting to make an agreement with the tenancy on the co-op.
I believe they've done it. I believe they've done it. The only problem is today, to get that building sold, those co-op units, they need, under the new Fannie and Freddie rules, they need 70% of the apartments to be sold, so they have a problem that they can't get mortgages for these people.
Well, we'll see though, because to Brian's earlier point, they still own it at a very, very attractive basis of somewhere in the neighborhood of $100 to $150 a foot. So at a certain point, when there is liquidity in the finance market, which by definition, if we're still coming to work every day, we still believe that will happen at some point.
I'm not disagreeing. I'm not trying to be the outrageous devil. But what's happening is, you have to be able to hold, because the same people.
That's the key question.
You have to be able to hold the situation. I mean, the reason that I have the four of you here is because I think you're going to be here for the long term. All I was trying to bring out is that in the short term, in today's situation, it's a much more difficult time than when you were on my show 3 years ago. Much more difficult time than when you were with Lehman Brothers, because everybody thought Lehman Brothers would be alive. You know, the world was a totally different thing. New York City, is New York City on sale?
Yes.
Or was it on fire?
You could also say all asset classes aren't created equal. So in terms of multifamily, I mean, there's a flight to quality, which is you know, bankers when things were going great, they could do every deal that they wanted that crossed their desk. Now they have to be more picky because their balance sheet is a lot more constrained. So they're gonna choose if they have a retail or if they have an apartment building.
You bring up a good situation. I mean, my colleagues are looking at deals and trying to do some financing, and you know, we have certain people say, we can see an apartment house in the Bronx. You can look at an apartment house in the Bronx. You're looking at opportunities. You may be able to sell.
We own in the Bronx.
So, what do you think of the Bronx these days? Today?
Bronx is great. You know, there wasn't such a irrational exuberance in the Bronx as there was in Manhattan, and also the rents didn't jump so precipitously as they jumped in Manhattan. So they're falling a lot softer, if at all. So it's a very steady market. It's a very steady market.
And I would just say we focus on buying properties in sort of dense urban areas, try to avoid, suburban areas where we might have to go begging for tenants. And so, in addition to sort of, focusing on urban areas, because that's where you see a lot of, tenant demand focus. It's also, that's where there's, we think Manhattan has, more liquidity than, suburban office properties. DC has more liquidity than, suburban markets. So we're focused on urban areas for that reason.
I'm primarily focused in key gateway markets: New York City, Boston, Washington, D.C., South Florida, where there's going to be continued population push.
South Florida?
Great opportunity. That's where I come from. People are moving there by the day. So they're having a very difficult time because of a major condominium mistake in the market down there. But over the long haul, if you look 10 years from now, when it's all absorbed, it's going to be an amazing market.
Mr. Silverman, I remember you had a property that you were trying to possibly market about a year ago or two in Long Island City. Mm-hmm. Well, what's happening with that type of property today in Long Island City?
Well, that type of property was something that I think you were able to sell at a certain moment in the market, and is much more challenging to sell now. That was a property that we were trying to sell subject to a change in zoning. And the change in zoning is actually moving forward, but it didn't happen quickly enough relative to the movement in the market. Long Island City is actually, from talking to people in the marketplace there on the condo side, an interesting market right now, because there's this separation that's happened in New York, and I would say that there are almost two cities residentially. There's Jumbo Stan or Jumbo Land, where people have to get jumbo loans in order to buy properties, and most often those people already own apartments that they're trying to get out of. And then there's Conforming Land or Conformistan, where places like Long Island City and parts of Brooklyn, where the prices are lower, people are eligible for conforming financing, and they're first-time buyers who don't have legacy issues. So what I'm hearing from my friends in the residential community is that we're starting to see more velocity in that segment of the market than we are in the more traditional Manhattan core markets.
So when's the world going to get better? Anyone want to on that?
I think it started to get better. I think that the worst case scenario,
Mr. Ray, the optimist.
I think the worst case scenario, the banks have survived. New York City did not break off and start floating out into the ocean. And I think fundamentals are deteriorating. So to me, that's the opportunity, is to find the right opportunities, the right seller, the right property location. That's, the opportunities again are upon us.
Mr. Silverman?
I wouldn't call it. I think the bottom is only visible in the rearview mirror, and I think that attempting to time the bottom, I would liken it to sitting at a blackjack table, getting an 18 and hitting and getting a 3. You were still wrong to hit the 18, and it's still a bad move.
Great move.
But you might do okay.
Mr. Chisholm?
My personal view is things are probably going to get worse before they get better. I'd say a big portion of this has to do with the fact that You know, there are banks, you know, we talk to banks because we think they're ultimately going to control properties, and we spend a lot of time going and talking and walking through our underwriting of particular property, and we see values significantly lower than where a bank is current, you know, than their debt amount.
So do you see it going down a little bit more before it rebounds?
Sure, and I think that's just related to fundamentals. I think that, you know, vacancy is probably going to increase in Manhattan, you know, across asset classes. I think rents, and that's going to put more downward pressure on rents, which is only going to drive valuation down more.
Mr. Rosenblum?
Values dropped so quickly, so fast, so much. I think that a lot of the pain, we're through a lot of the pain. I'm not saying we're through all the pain, but we're through a lot of it.
I don't think we've experienced much pain at all. I mean, there are banks out there that have loans on off, you know, the building that Will sold for $400 a foot, there's probably more than $350 a foot of debt on that building, and he just said it's worth $200. And I think, you know, if the AIG building's only selling for $85, I doubt that building would sell for $200.
Well, you wanted to say something.
Well, I would say two things. I would say, number one, I would say that it's really situation specific on particular buildings and how their debt will be worked out and quality of sponsorship. I think it does matter from the bank's perspective. But I would also say the thing that you have to look for is for the ability to control a variable, right? Underwriting is a multivariable equation. I have to make a prediction about rents, a prediction about financing, and a prediction about the market going forward.
And
we're not yet able to control any of those.
And I wish I had more time, but the prediction time, I just got the notice that we finished 30 minutes. I'd like to thank my young real estate leaders who are going to be around for many years, and I think things are going to be good over a period of time. It's going to take a little while. I'd like to thank Will Silverman, Brian Ray, Kevin Chisholm, and Jeffrey Rosenblum. See you next week.
Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman and Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, Kilroy Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, First Service Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Massey Knakal Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal & Rosenthal, Signature Bank, Sterling & Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Group.